Hello again, this is Alex with MasterChartsTrading.com, and this is market recap for Friday, May 19th, 2017. As you may have noticed, stocks became really choppy this week as they dropped from the all-time highs. Lots of red divergences are appearing on the chart, and evidence is sort of pointing towards a continuing correction. We'll look at financials, which are already retesting April lows, and in a sort of classic flight to safety scenario, real estate, staples, and utilities all moved higher, while retail XRT is actually getting really close to 52-week lows. Junk bonds proved to be more resilient than stocks, and investment-grade bonds really had a second excellent week in a row, and this is again showing a risk-off posture. Dollar index broke support and maybe headed lower towards November lows, and of course this is excellent news for the precious metals, and we'll look at that. I'm getting ready to short oil as it moves higher, and natural gas really didn't do much, just sort of chopped sideways. Finally, we'll finish off with copper as it retests 52-week. It may be headed for a retest of 52-week highs. Okay, let's start with our proxy for the market, S&P 500 ETF SPY. So here on Tuesday, we did hit fresh all-time highs, but next day we had a relatively big gap down, and more importantly we continued lower, and you can see we closed next to the lows of the day. So this is a very strong negative day, and some damage was done to this chart. Not that much, but there was some damage. I mean, of course, fresh highs are still the dominant feature of this chart. So even if we do get a correction, if we get a pullback, let's say we get, I don't know, 5-6% pullback from the recent highs, that would put us somewhere around December, January highs. So it's not a very big pullback, and if you put it in a historical perspective, it will be like a normal pullback. The reason why I think we may be headed that way, I mean, it's entirely possible that we do turn around here and continue higher. It is still possible. But now we have more and more evidence building towards I guess a correction camp. Namely, there are now divergences, and you can see them. Here's an advanced decline volume line for S&P 500. You can clearly see it is making lower lows and lower highs for the past 3 months, while the index itself is moving higher. The same goes for unbalanced volume. The advanced decline line itself is sort of indecisive, but it's not as bad as the volume. So you can see that the volume is definitely making a bearish divergence here. So this is one of the pieces of the puzzle. Here is S&P 500 again on a longer term time, just a longer term chart. Another breadth divergence. You can see the bullish percent index and percent of stocks above the 200-day is moving lower. In absolute terms, the numbers are still very good. Again, if we get to like 30s, maybe 20s, then I'll get really worried. But at this point, I don't really question the uptrend in the stock market. I mean, here's market breadth index. It's at 5, and it can't go any higher. So it's definitely in a bull camp. But you can see that there are now divergences, and divergences usually, well, sometimes they work out, sometimes they don't work out, but the way we've been gaining, we're definitely overdue for a pause. At least a pause, not necessarily a pullback. Here is another piece of the puzzle. This is S&P 500 on a weekly time frame. Here, what I wanted to point out is that we're topping out at this resistance point 1, and we now have basically 1, 2, 3, 4, 5 weeks that we've been trading very close to that resistance point. So can we break above it? Of course, but it's definitely showing signs of resistance exactly at the pivot point. So yeah, I guess we'll see if we are going to be able to break above it, or if we decide to take a pause. QQQ, of course, is the strongest of the bunch of the major ETFs. It moved just skywards, but then the same on on the 16th here on Wednesday, we got a gap down and selling. Thursday was a decent looking day, but Friday, if we closed, in the upper part of the candle, I would be much more comfortable, but we didn't, and looks like we closed in the lower part of the candle. So looks like the sellers did dominate, at the very least, the very end of the day trading. So that's showing that they're selling is present. The advanced decline lines did hit fresh all-time highs here, so no major issues for QQQ, but the thing is that QQQ cannot really exist in a vacuum, and S&P 500 is definitely more important than QQQ. So if S&P 500 decides to take a dive, then QQQ will absolutely follow. Here's QQQ on the weekly time frame, and I wanted to point out that notice that QQQ went above resistance point 1. S&P 500 is currently at resistance point 1. But notice that we could break above, but right now QQQ it actually is at resistance point 2. So looks like we're stalling there, and this for second week in a row. So these points are the resistance, support, pivot points. They're important. They're not, they don't always work out, but sometimes they do, and sometimes they're useful. Here's IWM. Several attempts to go higher. Here's one attempt to go higher, kind of failed. Here's another attempt to go higher, kind of also failed. So looks like we're having a series of failed attempts to break out. Kind of very choppy and messy chart, so I'm not a big fan of this chart, honestly. On this chart, a little bit longer term, IWM, clearly divergences are present. Here's a really good old RSI, pretty obvious divergence. So in other words, a loss of momentum. Price momentum oscillator, another divergence there. And percentage of stocks over 200-day moving average. Notice that we're now at 51%. So we've been steadily dropping for the, well, actually since December. So this is a divergence, and it is concerning. You can see that we made a higher high, but percentage of stocks above 200 is making lower highs and lower lows. So definitely concerning. Can this change, and can we turn around and continue higher? Absolutely, positively yes, but we could also take a pause, and I think we are definitely overdue for a pause. Here's finally the NYSE composite, and it kind of shows similar picture to IWM. We're making a higher lows here, higher highs, but notice that the advanced decline volume is moving lower, and I think even more important, the percentage of stocks above 200 and the bullish percent index has been steadily dropping as of the past few months. So I mentioned that we're witnessing somewhat of a flight to safety this week. So here are the major ETFs. You can see that real estate, consumer staples, and utilities all gained for the week, well, relatively strongly. While what the losers were transportation, financials, consumer discretionary, technology. So these are risk-on sectors, while here risk-off sectors this week really dominated. So let's look at the various sectors and see where they're going. For example, here's financials, XLF. And I've been mentioning that I didn't think we were done, this surge, I didn't think we were done with correction. I thought that we were going to be retesting April lows. Actually, I mentioned it several times in my previous videos. And looks like we are there, basically. We're on Wednesday, we pretty much came down there and kind of bounced off of that low. So financials, probably one of the weakest sectors right now amongst the major sector ETFs. You can see also we have divergences here in advanced decline lines. You can see that here in April we did not yet make lower lows, but you can see advanced decline lines already made lower lows here in April. So this is a bearish divergence here, and it looks like we're coming down there. Additionally, this could be like a head and shoulders formation, and if we do break it, then the height of the shoulders could be duplicated on the downside. And here's financials. Here's one of the reasons why I didn't think we were done correcting just yet. So these are multi-year highs. We came down here, and then basically I didn't see a strong candle here. So all of these candles here from March, they're either red or they have selling indicators of selling from the top of the candles. So none of these candles really looked strong to me, and I kept mentioning that we're probably going to retest April lows. Looks like we're doing that right now. We can do a conservative estimate of if we break April lows, and if indeed this is a head and shoulders, then how far can we expect it to fall? So let's do a conservative estimate. I don't know, let's say from here. So that's about 6%. And if we go down 6% from here, then we're most likely going to be retesting this big candle from November. Whether or not this will happen remains to be seen. It's also very much possible that we're just simply going to hold here, do a couple of hammer candlesticks and rally higher. That's also possible. Here's another sector that held up quite well. Consumer staples, fresh all-time highs here just a few weeks ago. But more importantly, I think, is that it held up pretty well and barely budged. Whereas other sectors on Wednesday here we had a big gap here. Notice that XLP barely budged. So definitely a much better sector to be in. Here's real estate, and this one really choppy as of late, so kind of came down. This hammer candlestick I pointed out a few weeks ago, and looks like this hammer candlestick is playing out, and the support is being found here at the 200-day moving average. Here's utilities. This one almost at all-time highs, and you can see there was barely any selling for utilities when the other stocks were dropping. Additionally, we have advanced decline lines, advanced decline volume lines already hitting fresh all-time highs. So this is bullish divergence, and we could easily break out to fresh highs, especially if if the investment-grade bonds also continue higher. I myself actually opened a position here in November. I still have it open. And here's a really weak sector, and this is XRT. it's just been chopping lower and lower and lower. It's kind of hard to see on a daily chart, but we can go to weekly, and what I did is I put in a 52-week channel here. It's a price channel, so I'm very close at the 52-week lows, and 52-week lows, when a security hits 52-week lows, that's not a good sign. In my opinion, you definitely don't want to be buying down there. So yeah, very big rejection candle here and just continued lower. So maybe maybe retail is like a harbinger of things to come. And here junk bonds pretty much followed stocks to the T. You can see that there was a drop here on Wednesday, a rebound, and actually junk bonds rebounded stronger than the stocks, and we're basically almost at fresh, we're very close to all-time highs. So you can see that correlation of junk bonds to stocks is very high, so you can expect them to move in lockstep. Of course, you can see the junk bonds at all-time highs in the weekly time frame, and the correlation is very high. So junk bonds at all-time highs is showing that there is still good appetite for risk, and the yield has been dropping steadily on this fund. So to summarize, it's possible that we will continue lower. Some sectors already are retesting April lows, for example, financials. And financials really is an important sector. And if it does break the April lows, then the rest of the market could easily follow it lower. Okay, let's move on to investment grade bonds. So bonds have been acting really well. And last week I was saying the same thing. I was like, why is there a big gap here, gap up? Why is there so much buying pressure present here on TLT when stocks are at fresh all-time highs? So it looks like we are getting our answer is that maybe there is a flight to safety that's happening right now. So another gap up here for bonds. So we have two gaps now. This is showing very strong buying pressure for TLT, for treasuries. So at MasterChartsTrading.com we do trade TLT. I have a position open myself, and I'll post it once it closes. But this is definitely showing a flight to safety. Notice there is a weekly hammer candlestick last week with a big follow through this week. Looks like almost 2% for TLT. We are coming up on resistance for bonds. So looks like we have 1, 2 breakdown here in November, and in April we attempted to run higher but ran into resistance. Now we're again attempting to run higher. And maybe this is the, this time is the charm, and we'll continue higher. So AGG is an aggregate bond fund. This one includes both some of the treasuries and some of the corporates. Similar patterns, two gaps, lots of buying pressure. Actually, even we basically closed the gap here from November, a gap down. So looking really good actually for AGG. Notice the very big strong candlesticks here. We may have already cleared resistance. Looks like we may be closing above it. And of course LQD, the strongest of the bunch of the investment grade funds, closed the gap actually last month, and this looks like a breakout, throwback, and continuation. Lots of buying pressure again, lots of two gaps here from last week and from this week. So this is showing a lot of interest in owning defensive assets. notice that we have definitely cleared previous resistance level from the broken support and on two very strong candles. So this is showing again showing strong preference for owning defensive assets, and when this is happening, there is a possibility that stocks might drop from here. Let's look at the Forex universe. This is US dollar on a daily time frame. So really got hammered this week. It looks like there is a support break and we've moved lower, and now we're within the striking distance of the November lows. This is not a great sign for the dollar. I wouldn't necessarily put a nail in the coffin of a dollar bull run, but of course, you know, dollar moved pretty much lower against all other currencies. So I thought that we're drawing some sort of a cup and handle formation. It's still possible. Maybe this is a very deep kind of cup and handle formation, but looks like we're making a series of lower highs and lower lows. And if we do get to November, this is a weekly time frame, by the way, we possibly may, you know, we're not gonna hold it. We can continue lower. Anything is possible in the stock market. So another possibility is we do hold it there and then turn around. That of course would be kind of bad for gold. Pretty much dollar lost ground against all major currencies. So euro versus US dollar. I thought here that, you know, it was already quite a bit of selling, and I would have shorted it here. I don't trade euro, but I don't trade currencies in general. But looks like this was a failed trade. Would have been a failed trade. So now maybe we're seeing a real breakout. Longer term weekly charts, still these are multi-year lows, so maybe we're simply bouncing from multi-year lows, kind of like what we had here back in 2015 or, you know, into late 2015. I think we need to see kind of like a lot of buying here. Maybe we'll break above previous highs and then continue higher. Then maybe euro will stop going down, but for now I'm still questioning this breakout. British pound also pretty good month so far. Looks like we're having prices definitely moving higher here, and now we have a golden cross here. 50-day moving average is moving above the 200. But again, longer term, I still think we're in a downtrend. This of 30+ year lows, and this breakout still is tentative, and I would still short it if I was playing this in a weekly time frame. US dollar versus Japanese yen, I thought we were going to continue higher, but I drew this line here around 115.5. We needed really to break above that line to kind of confirm this fallen flag, and we didn't, so we turned around this week. So, you know, it's not always possible to predict. Well, it's quite obviously not possible to predict, but the dollar really gained, rather lost ground against all currencies. Here I still think the yen is in a downtrend, but maybe we'll just see lots of chopping around. And here is US dollar versus Canadian dollar. This week really also excellent for Canadian dollar, bad for the United States dollar. But so far, I still think that this is an uptrend in security. In other words, the Canadian dollar is in a downtrend. Okay, let's look at gold. Here's gold on a daily time frame. This is a continuous contract. So good news today, this week rather, we had a golden cross where you can see that 50-day moving average 1249.76 is now above 200-day moving average was at 1249.74. So this is a positive news. You can see we had a bearish cross or death cross here in December, but now we have a golden cross. So this is good news, and definitely a falling dollar is helping gold. So I've been pretty consistent that gold is in an uptrend. We had a really deep correction here, and with the dollar gaining to multi-year highs, it was kind of difficult to see where this is going. But now it looks like we have reaffirmed an uptrend for gold, and this is a weekly time frame. Looks, good 2 weeks here in a row. This week gained 2+%. Here's the reason why I was bullish. This is a longer term time frame, about 6 years worth of data, and a weekly time frame. My proprietary index here, Goldbrad's index, it became bearish here in April 2012 and continued being bearish. So all of this rallies I would have shorted. But here back in March of 2016, we had a breakout. Notice that we had this breakout and then we came down and we actually went below it. But I didn't really give up on gold. The reason being is because my Goldbrad's index did not confirm this breakdown. We were pretty close and we could have entered a fresh bear market, but we didn't, and we held on, and now we actually improved, and we are now definitely in a bull market here. Here's the same indicator on GDX. You can see that similar basically picture, but GDX moves stronger, and you can see that we broke out and basically came down around the breakout level. So definitely bullish chart. Additionally, there are some really good news here on the daily GDX chart. So first of all, Goldbrad's index has improved. I think more importantly here we have a higher high in the advanced decline lines. So relative to April high, you can see that we made a lower high so far in the GDX itself, while we're making a higher high in the advanced decline line. So this is definitely a good news and a positive divergence. Weekly time frame GDX, we have resistance up here and previous peaks here around 25.80 or so, but I'm liking the fact that we have a bullish divergence, so maybe we'll actually break above this resistance. And here are some other indicators that I follow. Again, these are proprietary experimental indicators. So we have percentage of stocks within GDX on a buy signal, and we had a big news here is that finally we have a bullish trigger. We had a bearish trigger back in October, and we were not able to recapture the bullish trigger. So definitely a good news here. Percentage of stocks, GBI raw data is also moving higher. So this is also very good news. We're a little bit overextended to the upside, but notice that this is like an oscillator basically. Breadth oscillator here in 2017 January, February, this oscillator became positive and around 5, 6 or so, but notice that the index continued higher for a while. We're basically there, we're around 5, so we could turn around and move lower, but I think that it's also possible we will continue higher and actually finally break above previous resistances from February and November. Okay, let's move on to hard commodities. Here is West Texas Intermediate, like crude oil, on a daily time frame. So definitely bottomed out here, big hammer candlestick, moved higher. So now I think we are overbought, and I think that this is a bearish security for several reasons. One is there's a glut of oil in the world, and the second one I'll show in the weekly chart. So now I'm going to be looking for basically for a failure, so I can kind of join the downtrend afterwards. To me, this is a sharp rebound. This is a clear, like a counter trend rally, and I would be looking to short it on a failure. Where this failure will occur? Well, we did clear the first the pivot point, but now there is resistance R1 here at around 52.60, and of course previous high here and the previous pivot point. So anywhere in this area, most likely, well, it could anything could happen. It could just skyrocket higher, and then maybe my analysis will change. But I would be expecting failure somewhere around $52 and $54 here, maybe 55. Here's the reason why I think oil is bearish, is because we're basically still in a downtrend. Even though this is a 52-week highs, I repeatedly said this, I think this is sort of an accidental thing, because this rebound from February 2016 lows just took so long. But now I think the downtrend is reasserting itself. Here's natural gas. Didn't really do much. Well, we had a drop here, but then by the end of the week we rallied. So not. I guess we had a first attempt to break out above previous highs, so that potentially we could re-challenge 52-week highs. This one so far failed, and we've moved back into the trading range. Here's natural gas on the weekly time frame, and you can see basically a trading range. Somewhere between $3 to 3.2, 3.1, and 3.4. If we do break above 3.4, I think we'll re-challenge 52-week highs. Here's copper. It's kind of getting really interesting, I think, copper continuous contract. So this is a 52-week highs here in February, and then we basically pulled back. But now, this week, we've been kind of, I think we have stopped falling, really, and especially on Friday we had a big white candlestick. So I think there is now pretty decent support here at $2.50, corresponding to lows from December 2016. So it looks like we are finding support here. And it's even more obvious if we look at it from the weekly perspective. You can see around $2.45, $2.47. Looks like we're finding support, and we have some nice big white candlestick, and price attempted to go lower, but really failed. So I did not hold. All right, if you like what you're hearing, please do like this video. If you have any comments, do comment below, and of course share this video with others who might benefit from it. Please sign up at MasterChartsTrading.com for our mailing list, and you will get a discount on my trading services. Thanks for watching, and have another great trading week. Bye-bye. So I wanted to show you how to find us on the internet. Please go to MasterChartsTrading.com. We do have a trade alert services which are live right now, so please consider signing up for the service. It's only $24.95 per month. Also, if you sign up for our mailing list, you get a discounted membership. You get to see what I'm buying and selling, and which funds I'm looking at, potential buys, sells, etc. There's quite a bit of members-only content once you log in. There's a lot of information about risk control, which is actually extremely important for traders, because the preservation of capital is really one of the paramount to the successes in trading. There's quite a bit of psychology of videos, psychology of trading videos in the members only section as well. Also, I'm going to be starting a Dividend Aristocrats service. For now, it's free for the members that are logged in, that are already paying members. So that's another benefit to signing up soon. The blog section shows the previous posts and market videos, of course. Also, I've added a new section here, which is FAQs, and I do get quite a bit of questions about various, ideas and questions about the market. So if you do have a question, please don't hesitate to send it in. Send it here, and I'll be hopefully I'll be able to answer it for you. All right. Thanks for watching, and please consider signing up for the trailer services. Bye-bye.